everybody, Wesley here. Today I'm bringing you my 6 favorite investing ratios. For this example, you can see in the top right, it is APR.UN. That is a automotive properties REIT. They invest in car dealerships. They more invest in the properties that the car dealerships are on. So our first ratio for today is the price or the PE ratio, and this ratio is the price you pay for the company's earnings. And so for our example, APR.UN has a stock price of $10.12, and their EPS or their earnings per share is $2.40 a share. So you get the stock price, you divide it by the earnings per share, and you get your PE ratio. Now our PE ratio is 4.2 times. So as an investor, you pay 4.2 times, in our example, 4.2 times more earnings for the stock price. So what this ratio is really good for is typically the lower the better. In some scenarios, some not. It all depends on your industry. For REITs, you always want the lowest one. At least that's what I do. That is my opinion. I always try to find the lowest PE ratio. And so when you invest, you typically want the best stock you can get for the lowest price, because then it would be undervalued. So then when the stock price adjusts for the actual value, of course the stock price will rise, and you would have paid less for the actual worth of the company. And so some companies are really high. I did another review of Capital Power. They're a utility company here in Canada, and they had a PE ratio of something like 30 times. So the stock price is 30 times greater than the earnings per share. So you are paying a huge premium on the stock price compared to how much the company is earning. So that's why I typically lower is better. Some stocks, such as like Google or Amazon, they'll have an extremely high PE ratio, which isn't always a bad thing for some growth stocks. With a higher PE ratio, it can also validate a higher growth earnings. For the second ratio we have, it's the debt to total assets. So our debt to total assets is the assets provided by the creditors. And so to get this, you get the total liabilities. In our case, this is in thousands, so this is actually 377 million. But you get the total liabilities, which is 377,395, divided by your total assets. In our case, this is 547,606, and that gets us 69%. And this is in thousands, so this is actually 377 million. This is actually 547,000 million. But 99% of the time on the financial statements and on the balance sheet for this one, it'll always be either in thousands or in millions. And so 69% of our total assets is funded or provided by liabilities. And so obviously the lower the better, because the lower of your assets you have that are provided by creditors or liabilities, the less debt you have. So when investing in a company, it all depends on the industry again, but for REITs, this is typically higher. I believe the average for the industry is right around 60, maybe some companies 65%, so this one is a bit higher at 69%. For this company, it doesn't really bother me, because for a REIT to grow, which is a REIT is a real estate investment trust, they need more properties to increase their bottom line, or their total revenues, their gross profit, because with a REIT you typically can't make the same property more profitable, where you can, let's say if you were to sell a widget, you can make the widget more profitable, where with a property you can't so much. And so this number doesn't super bother me, even though it's almost at 70% of the total assets are provided by creditors. That is fine for a REIT's case. In other industries, you need to look out for this number, because some industries you don't want over 40%. For our third ratio, we have the payout ratio. This is the amount of net income that is distributed to investors. This is how much of the net income is distributed as dividends. So for the payout ratio, this is different than the dividend yield. The yield is the percent that you get as an investor. This is from the company standpoint, so this is how much the company has to distribute to you, the investor. So for this, you get the total dividends paid, which is our case. This is yearly. This is for the 2017 calendar year. This is 23,297. Again, that's in thousands, and then this is 38,467. So you divide the total dividends paid by the net income times 100 to get you your percent. For this year, they pay out 60% of their net income as dividends. So this ratio, this number at the end, 60%, is super important for value investors, or for those who buy and hold a stock for several years or even decades, such as what Warren Buffett did, because the higher this percent is, the less money this company has to reinvest into future properties to increase its revenues. And so 60% is pretty good, especially for the REITs. For REITs, if you didn't know, if they pay over 85 or 90% or so of their net income, they don't have to pay taxes. And so you don't want this too high for other companies. If it's not a REIT and it's too high, they don't have any money to invest into new technology or into for our fourth ratio, this is times interest earned. This one's also very important, and this is the ability to make interest payments. And so to get this ratio, you get the net income, which in our case is 26,249, plus the interest expense. The interest expense would be on like mortgages or loans from the bank. And then you also add your income tax expense. You can notice that we don't have an income tax expense in this, in our example, because this REIT does not have to pay income tax for this year. Most other companies will obviously have income tax, but this one does not. And then you divide it by your interest expense, which is 7,817. And I guess I didn't write it down, but this is a 4.2 or 4.23 something times. And so the higher the better. So with 4.2, that's how much they earned in net income compared to their payout of interest expense. So they could pay out their interest expense 4.2 times with the net income that they received. So this is very important for any company that has debt, because it shows how much money they're making compared to how much they have to pay out in interest. So this is especially important in a REIT scenario, because they're going to have lots of loans and mortgages for properties that they buy. And so 4.2 times is good in this scenario. A last ratio we're going to finish off today with is the profit margin. Now your profit margin, you get your net sales. So again, for our example, it's 35,452 minus your expenses, which is 9,203, divided by our net sales, gives us a percent. So you will have to times your answer by 100, which gives us 74%. Now this is the percentage of sales that turn into profit. So 74% of our net sales, in our case this is the rental income, our net rental income, minus all of our expenses for our rental incomes, which gets us obviously our percent right here. So this is great even for the REIT industry. 70% is quite a bit above the industry average. For other industries, this is going to be much lower, because you will have your expenses will be a lot higher. For REIT, there isn't a lot of expenses other than just maintenance and administrative costs and whatnot. And so this is one I look for in the REIT space to see how profitable each sale is worth. The higher, obviously, the better. That will be our last ratio for today. Our website is matterbrain.com. You can follow me on Instagram. My handle is just matterbrainweb. And I also tweet once in a while on Twitter, which is @matterbrain. at mbweb_finance. You can follow me on all of those. Thank you so much for watching. I know this video was a little bit dry, but ratios are extremely important when it comes to investing, and knowing how the ratios work and how you can calculate them will definitely help you in your investing career. Thank you so much for watching. I'll see you on the next video.